JJ the CPA here. Hope you're doing well. We will start the CPE, scratch that, tax seminar. I'm offering CPE, but this isn't that. Goodness, right out the gate, needed to correct myself. Hope you're doing well. So at the 5-minute mark, if you're watching this seminar later, just skip to the 5-minute mark because that's when we will start the actual seminar. So look forward to going through this with you. We're going to cover a lot of good stuff. And I see that CSR is the first one in. And Patrick, thank you so much. So again, we'll start at the 5-minute mark and we will get into this. Thanks for being here today. And we'll be following up in here just a second.
Hello, and good afternoon, everyone. Thank you for jumping on. We will be starting right, now we have 2 minutes, so we'll be starting here in a couple of minutes, right on the dot. So we're just on a little bit early so everybody can get settled in, and then we will get started.
JJ the CPA here. Hope you're doing well. We are going to start the seminar at the 5-minute mark. That way there's time for those of you that are attending live to be able to get on. And thank you for being here. If you're watching this after we aired this live, feel free to just fast forward to the 5-minute mark. And that is when we will start the seminar. Very excited.
It's so awesome to see so many familiar names on here. Hello, CSR, of course, and Patrick and Janelle and Karen, the CPA, and Blue Line Tax and Accounting Services. Hello, Kelly Thomas and Rob with Imagine That Toys, as well as Gary. We will be getting started here shortly. We're just giving time for people to get on. If you were watching this on you're rewatching this, please just go to the 5-minute mark, and that is whenever the seminar will begin.
All right. JJ the CPA here. Hope you're doing well. Thank you for coming on for my free tax seminar. This is for informational purposes for the YouTube community. I want to thank you all for your wonderful support. If you haven't subscribed, love it if you would. I am now offering tax seminars beyond this one. I've got a couple of I got 3 federal tax updates, an employee retention tax credit update. Just wanted to share with you all. Who am I? If you haven't really gotten the background of JJ the CPA, I've got over 28 years of experience, all in tax. I've had my own CPA practice for over 24 years. So I have been in the trenches, traveled around the country to over 50 cities presenting to fellow CPAs covering the recent tax law and strategies. And you know this, I'm proud to say that I'm a YouTuber, if you will, with over 76,000 subscribers, 6.2 million views. So honored by that. I've authored 2 books that you can find on Amazon. Just Google JJ the CPA. I'm licensed in Oklahoma and Texas as a certified public accountant. I represent clients before the IRS. Therefore, I'm licensed with the IRS in all 50 states in our great American country here. I'm a member of the American Institute of CPAs, as well as the Oklahoma Society of CPAs, because I am out of Oklahoma and a few other things there. But I want to help from this point forward even more for those that maybe have an advisor on tax, but need to get some additional information that they can take to their tax advisor to ask additional questions. So what's obvious here is that I'm not your CPA. I wish I was, but I'm not. And like anything, what I'm presenting today is informational, which means this: you're taking this information, giving yourself some ideas so that you can go to your advisors and say, listen. And maybe you don't start it out by saying, I saw this guy on YouTube, but you can say, listen, I was reading or following up, or I heard, or I read, or I watched something about, does it apply to me? This is the biggest thing that I love about our YouTube community, is that you're coming here for information to, in essence, help yourself, which you should. So yes, I am going to plug, I've got 4 seminars coming up: a federal tax update for individuals, one for businesses, the employee retention tax credit. We are going to talk about that, but I've got one that's a deep dive, as well as then a federal tax update that talks about both business and individual all in. Those are 3 hours long. You can go to my website to sign up for those, pretty lickety split. Each one is $97, and the ERTC, because of the materials you get, is $197. I am also offering continuing professional education. I'm very excited about that. CPE, which is for CPAs. What you would do is go to jjthecpa.cpe.com. These same courses are available, but also then you could get your CPE if you sign up through that website to ensure that you get all the qualifications. And then lastly, stick with me, I've got an ERTC seminar that is out of this world, blows your mind, and it's hard to not feel like I'm telling you, like I'm trying to sell you. But with the employee retention tax credit, there is so much that is being missed by employers that have employees that pay payroll that haven't yet got this credit. Somebody left a comment on one of my videos saying, you know, why are they call this a tax credit? Because it should really be called a grant, because this money is real money. It's not just a reduction of taxes. It's money back in that employer's pocket. Well, listen, it's so overwhelming. I get it, but I put together this seminar that walks you through everything related to it, and you get all of these materials to go along with it instantly, so that when you sign up, you don't have to wait. You get the examples, the flowcharts, the Excel spreadsheets, as well as links to all of these various forms. And yes, these are all forms, the IRS forms that you're able to get otherwise, but I've got it all in one spot. And then I walk you through. Each one of those seminars is 3 hours. As always, I want to thank all of my subscribers for all of your support. I guarantee most likely, if you are on, you're watching this, you are a subscriber, but I will tell you this, if you come across this live or later on this tax seminar, if you're not a subscriber, I would love it if you would subscribe. All right, you guys ready to rock? Because I am JJ the CPA in the house. Let's get rocking and rolling, actually deep diving into these tax seminar issues that we're going to discuss. All right, PPP and PPP forgiveness. So we know yesterday PPP, the program officially ended. It's over, but we still have things to deal with related to PPP when we go to file our tax returns for 2021. That's right. And we still have to deal with PPP forgiveness. So what are the big questions that we usually come across, at least for me? Is PPP taxable? Nope. Do you have to report PPP as income? No, it is not taxable income. Does PPP reduce your tax deductions? It does not. So it has no tax effect. This is the same for the self-employed, Schedule C, Schedule F filers. And then when is the PPP forgiveness application due? It's due by the maturity of the loan. And how long are payments deferred? So when you get a PPP loan, there was a disbursement date, the date that you got the money. You take that date plus 24 weeks plus 10 months, and that's how long the payments are deferred. That's also how long you have to put in your PPP forgiveness application without having to make any payments. Now, there does seem to be some confusion. I've got other videos about it, but when should you file for PPP loan forgiveness? Well, anytime up until the payments are done being deferred, right? So in the first 24 weeks, you don't have to send it. You're in your covered period. In the first 10 months, the payments are deferred. You don't have to send in your forgiveness. Now, I don't know why you would wait, but you don't have to. Now, we're deep enough into this, you might be asking, man, I wish I had a copy of these slides. So in the body of this video, you will find a link to go and get the materials that you're seeing right now. It's a PDF copy of this PowerPoint presentation. It's at jjthecpa.com. It's on the seminars page and it's at the bottom, and there is a picture that says materials to the free seminar that's being put on. So you can go there, click on it, and you'll be able to have a PDF copy of these same slides that I'm presenting to you. So if you want to take some notes as you go along, part of the reason I'm doing this seminar is I'm giving you a taste, right? I want to give you an idea of what do these seminars look like, JJ, because it sounds pretty boring. You mean I'm going to take a tax seminar? I got somebody for that. Guess what? You may have somebody for that, but that person that you have tackling your taxes the way that I do for my clients still expects you to have some kind of understanding of what is going on. And more importantly, this, and I talk about it in my book, the more you have a better sense of what's going on related to your situation, the better you can ask questions. So with that being said, go and get the materials if you'd like to follow along. So let's talk about this. Back to the PPP loan and the forgiveness question. So many are hearing this. The bank says, if I don't apply for the PPP loan forgiveness in time, the SBA will not forgive it. Well, that's absolutely not true. Not really. So what does that really mean? What do you mean not really? So only if you didn't, hear me on this, only if you didn't file the PPP loan forgiveness 5 years after you got the PPP loan, ding, 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 that's the maturity date. Now, if you got it on or before June 5th, it's a 2-year mark. That's the law at the time. But you have until then. Now, why would you wait till then? You wouldn't. You would not wait until then to file for forgiveness. Why? Well, you'd be making payments during that time period, right? So there's a real misconception. Unfortunately, the banks even seem a little confused, which baffles me. So what do you do if I don't apply for forgiveness and they start paying, they start sending me payment vouchers? The bank is telling me I got to pay on this. Oh my gosh. Okay. Take a deep breath, make payments, apply for the PPP loan forgiveness. And when you get the PPP loan forgiveness, the SBA will pay the bank. Rest assured, the bank wants you to get forgiveness. Why? Because they don't get their money until you get forgiveness. Follow? So It can help the bank out at this point. No reason to delay. Let's talk about the EIDL and the EIDL grants. We're talking about the tax aspect of this, right? So is the EIDL taxable? No. So it's a loan. Now, what about the grants? We know we had the EIDL grant, the supplemental grant, the targeted supplemental grant. Is that taxable? It is not. Now, do you report the EIDL or any of the EIDL grants as income? No. So you don't have to show that. Does the EIDL or any of the EIDL grants reduce your tax deductions? They do not. What's important here is that when the law first came out, there were different answers to this, but this is the current law that came out of the Appropriations Act that was put into play into law right at the end of December 2020. Now, is this the same for self-employed individuals, Schedule C filers, Schedule F filers? Yes, absolutely. When do payments begin on the EIDL? Well, now, no matter when you got the EIDL, it's 24 months after disbursement. Now, the big question is, does interest accrue while the payments are being deferred on your EIDL, right? Yes, that does accrue. So from the date that you got the loan, there is going to be interest that is accrued. It is not like the PPP. Will I have to report any additional information to the SBA after I got the loan? Well, receipts upon SBA request, you need to keep those 5 years well beyond from when you spent the money. There's a 3-year blah, blah, blah. You can go, well, what is in this? You need to keep your receipts. You need to keep the receipts to show how you spent the money. How long do you want to keep those receipts? I would keep it 3 years past when you've paid it off, if not 5 years past when you paid it off. You don't need to worry about how long you need to keep them because you just now got them. What you need to do is make sure you have the receipts. Now, according to the EIDL loan documents, an annual financial statement within 3 months after the close of the year appears to be something that the SBA will be requesting. How, when, how do we go about that? We don't know yet. I haven't seen a single thing about how to go about that, but it may be something that is yet to be seen because we are not there yet. So what can I use the EIDL and EIDL grant for? And right now you're raising your hand. You're saying, JJ, I got a lot of questions on that. I got a number of questions. Well, know this, I got more than this video on YouTube. I've got a playlist of EIDL loan and grant, and I have specific videos that talk about what are the uses. So let's talk about the big questions related to that. It's for operational expenses, business debt, and new assets with some exceptions to that. Can I pay myself, the owner, with my EIDL or EIDL grant? Yes, with exceptions. And those exceptions are that you can pay yourself for what it is that you're doing for the business, for services, if you will. Now, remember, Schedule C and Schedule F filers, you are not an employee, period, the end. It may feel sophisticated. It sounds sophisticated to say, well, from my Schedule C, my Schedule F, I pay myself, my payroll is X. Well, yes, in our terms, on the street, right? When we're passing each other on the street and say, oh yeah, here's my payroll. Well, we got to remember, we're not on the street when we're talking about IRS. We're definitely not on the street when we're talking about the SBA. What you need to know is that when you're a Schedule C filer, a Schedule F filer, there is no, in the world of the IRS and the SBA, payroll to you. Doesn't matter what you call it. Doesn't matter that you say, no, 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 no. Every Friday I cut myself a check for $500. And in the memo, I put pay. I put payroll. I put paycheck. IRS, SBA dictates, I have videos on this, one came out today, that you're not an employee. It's in the IRS regulations as well as the SBA. You're not an employee. You're self-employed. Do you want to be an employee? No, you're self-employed. With that being said, then how does the self-employed get to pay, quote unquote, themselves or use the EIDL or the grant for their personal expenses? Well, it follows the same formula that it is for the PPP. So whatever formula you're using to determine what your PPP is, which is line 31 of Schedule C divided by 12 times 2.5, that is then the amount that you're able to use. Where is that, JJ? Well, it's right on the SBA website. Now, what I want you to remember is this, okay? This is the big takeaway right here. I wish you could see me right now because my Hands are shaking, going back and forth to really make sure that you hear this right now. This is a loan on the EIDL. Obviously, the grant's not, you don't have to pay it back. This is a loan. This is a loan. What I want you to do is get a hammer, put it in your hand right now, and then get ready to smash your fingers if you're doing this, or you're thinking about doing this, or you think this should be something that you do. So get the hammer ready. You ready for this? If you use EIDL money to pay yourself, you're going to have to pay it back either way. You have to pay the EIDL back. So what you're doing is, now, especially for those that are paying themselves a wage, most notably through a C Corp or an S Corp, or those that are paying themselves guaranteed payments in a partnership, you're now loaning money that you have to pay back, and you just turned it into taxable income. Boom, hit your hand with the hammer. Not really, please don't. You follow? You borrow money, cuckoo, cuckoo, to pay yourself a wage, cuckoo, cuckoo, because wages are taxable and wages are subject to payroll tax. Why are we trying to find ways to pay ourselves with a loan that we have to pay back, and we just created income? Okay, hit yourself again with that hammer in your hand, and you're going to have to pay payroll taxes. So you just borrowed money, and you now are going to pay income tax on those wages as well as payroll taxes. And if you're your own employer, which you are, if you got the EIDL, those payroll taxes are 15.3% when you take Social Security and Medicare that was withheld and matched, and the income tax. Now you might want to hit yourself in the head because you just turned a loan into something that you're going to pay about 50% tax on. You may pay up to 35% federal and state and 15% in payroll taxes. So don't try and find ways, well, I want to pay myself. I want that money from the EIDL for my personal expenses. Not necessarily the smart way to go when we're talking about taxes. Now, what are the big questions for the ERTC? What is the ERTC anyways? The Employee Retention Tax Credit. Sounds boring, JJ. Well, it's not. Okay, I have somebody that watched one of my videos. They went to their CPA and they said, hey, I think I qualify, watch this video. And then boom, boom, you ready for this? $450,000 for one quarter. Boom, they got it for the next quarter. Boom, they got it for the third quarter. Boom, this is a ton of money that this person got, over 1.2 mil. Yeah, they probably have a lot of payroll, but this is something that we really need to make sure you're not missing. So is the ERTC taxable? Yes. And then many stop right there and like, oh, wait a second. Whoa, 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 whoa. I am not going to take money that I'm due as a tax credit if I have to pay tax on it. Are you kidding? Okay, wait a second. Put the hammer down, because you're not going to hit yourself in the hand with a hammer because of this. You get that money, and even though it is a tax effect, after tax, you are still ahead of the game at least 60%. You're ahead of the game. So for you to say, I don't want that 10 grand. No, don't give me that 10 grand. I got to pay tax on that. What? Okay, so on that 10 grand, maybe at most high, you pay 40%. What? I got to pay 40% taxes? You just got 10 grand. If it has a $4,000 tax effect, you netted 6 grand. Okay, you netted 6 grand. So if I'm on the street, I'd say you netted 6 grand, yo. I mean, are you kidding me? You netted 6 grand. What are we complaining about? Now, you're probably not complaining. Now, do you report ERTC as income? Wait a second, JJ, you just told me it's taxable. You do, though, reduce down your deductible wages. So it does increase your net income. It is not a reason not to get the ERTC. When does the ERTC reduce down deductions? Now, this one is going to be a shocker. I was shocked. I'm going to show you where it comes from later because we're just hitting the big questions, but it's in the year the credit was applied to. Huh? What do you mean? Well, if in 2021, you filed for the ERTC tax credit on wages that were in 2020, no matter when you get that actual ERTC credit recognition, the money, the check. It is something that affects the 2020 tax return. Whoa, that doesn't make sense. That's not fair. I would agree with you, but IRS Notice 2021-49 dictates otherwise, which we talk about here in a little bit. So if I get the ERTC credit in 2021, that was an ERTC for 2020, what year do I reduce the taxes? In 2020, just as I had indicated. Doesn't seem fair. Well, it's the tax law. It's not meant to be fair. It's just the law. It's not unfair or fair. It's just the law. Now, what if I haven't received the ERTC credit yet, but it was for year 2020? What year do I reduce wages? Well, the IRS is saying it's 2020. Now, is this the same for self-employment individuals? It's no, because the self-employed do not qualify for the employee retention tax credit on their earnings. Now, can a self-employed individual get ERTC? Yes, but only on their employees' qualifying wages, right? We talked about earlier, Schedule C filer, Schedule F filer, you're self-employed. You don't have a W-2 to yourself. You can cut a check and call payroll, but that is not reported on a Form W-2. In fact, the IRS in Schedule C instructions, which I give you a link in the video that recently came out, I give you a link to those instructions that the IRS says you cannot pay yourself wages. And if you're dumb enough, whoops, it doesn't say that part, but it says, if you do, you don't get to deduct those wages. So a self-employed individual doesn't have wages to themselves. That's why they don't qualify. But if they have employees, they can qualify for this on the wages they pay their employees. Now, here is the big one. And if you're still controversial about it, you are not in the know. You are not in the know. So get in the know, because that's what I want to do. I want to get you in the know. We're going to talk a little bit further here about the details, where this comes from. But for now, big question. Does a more than 50% owner qualify for ERTC wages? No. Unless under Code Section 267C of the Internal Revenue Code, they meet that exception, then they do. But I'm going to tell you this, it is maybe 1 out of 1,000 that would meet that exception, and it most likely isn't you, because you'll be in a sad state of affairs if it is. Now, does the spouse of a more than 50% owner qualify for the ERTC wages? No, unless under IRS Code Section 267C. Right? I'm trying to make the code stuff sound a little more sexy, if you will. But the answer is no, unless you meet the exception. Well, JJ, what's the exception? Well, we're going to get into that. Now, I don't want to tell you that I'm going to be less entertaining as we move forward, but for those of you that are CPAs, you're looking for CPE, I don't expect I will use various voices when I deliver it. No guarantees. But with the EIDL, let's do a little more deep dive into the EIDL. Now, I want you to remember, these are all the rules and regulations as I know them, effective today, which is November 16th, 2021. And I thank you so much for being here with me today. Depending on when you join, I want you to know in the body of this video is a link to these materials if you'd like to check that out. So at the very bottom or in the body of this video, you'll see a link. It's at jjthecpa.com and on the seminars page and at the bottom. And you will be able to have a PDF of what I'm presenting for yourself. You can print out and take notes. All right, so we're deep diving into the EIDL, the Economic Injury Disaster Loan. Here's what I want to make sure we all hear. I want to make sure you hear what I'm getting ready to say. It's an injury disaster loan. It's an economic injury disaster loan. I'm going to have some videos coming out. Some of you might be scared after those videos, and I don't want you to be. So I'm going to touch on that. What am I even saying here? If you didn't have an economic injury disaster loan, you didn't qualify for the EIDL. And the SBA may come back later and say, yeah, we're going to need you to go ahead and pay all that back because you were not clearly an economic injury disaster loan. And it's not, did I psychologically think I was in an economic injury disaster? It is, were you? And expenses only count for the use properly of EIDL while you are in an economic injury disaster timeframe. So it's in the standard operating procedures, and I'll have some future videos coming out. Then I'm going to show it to you. It won't be per JJ the CPA. I'm going to show you, give you links. You'll be able to read it for yourself in black and white. But the one thing I want you to know is that the rules are all the same, whether you got the EIDL, the advanced grant, if you were lucky to get that last year, the targeted EIDL advance, and the supplemental targeted EIDL advance, meaning the rules are the same for all of these. None of these have a tax effect. And the EIDL program for the COVID pandemic ends 12/31/21 or when funds ran out. Now, you may not know this, but the EIDL was around before the COVID pandemic. It's been around for years. It's meant for those that are in a disaster, typically tornado, fire, flooding, hurricane, drought, and those businesses that are affected by that. The EIDL was extended to those that were experiencing an economic injury disaster related to the pandemic. So what I want to make clear to you is that those that are going through that, recovering from it, related to that, that program ends 12/31/21, but the EIDL still exists for any of those other types of disasters that we talked about. But remember, when we're talking about the EIDL, we are talking about a loan, not the grants, but the loan. Now, the SBA did come out with some updates on September 8th, and this is directly from the SBA website. This slide was copied and pasted from a public slide that is on the SBA website. Basically with this, the reason I wanted to put it word for word is that it's better to just see it black and white per the SBA on what the changes are. So what are the changes, right? So these are all the technicalities and the NAICS, but directly from the SBA website, what can I use the loan proceeds for? Well, pay, prepay, business, non-federal debt incurred at any time, past or future, that's new, including monthly payments, payments of deferred interest. It can pay for regularly scheduled payments on federal debt, payroll, rent, mortgage, utilities, and other ordinary business expenses. The big key here is that if this is a normal operating business expense that you're going to tax deduct, that is something that is really going to fall in the, fall on the train tracks of what you are able to use the EIDL proceeds for. So if you find yourself going, well, could I use it for this? Probably not. Well, what if I did this? Probably not. Why? Because you're inventing things to go and spend the money on. What I want you to remember, you don't have to pick up the hammer to hit your hand here, but you are having to pay this money back. It's not like the PPP where you're trying to ensure that you're using it properly and therefore you have to use it to then get forgiveness, because there is no forgiveness. Now, the one thing to note, this is all directly, word for word from the SBA website. You can go to sba.gov, boom, you'll find this. But the borrowers that have an existing COVID EIDL are able to use these loan proceeds the same way. So even if you got the EIDL before September 8th, you get to take advantage, for lack of a better word, of what you can do now. Now, what may not be a use of the fund? So you can't expand your business. You can't make prepayments on debt that is owned by a federal agency, including the SBA. Now you'd be like, whoa, I heard you could make payments to the SBA. Well, what I just said is prepayments, right? So you can make payments, but not prepayments on any debt owned by a federal agency or an SBIC, small business. And you can't start a new business with it, okay? So the loan is to the business that applied for it, and the loan is to help the existing business get through an economic injury period of time, and not to just have money sitting there, money to invest, money to make us feel good. It's not for that. So I think there's going to be a reckoning in 2022 and after that SBA is going to see that much more dollars went out than were actually needed, which also means that the government will say, going to need some of that back. So you need to know that this isn't just some other governmental program that if you got the money, boom, you're scot-free and you pay it back over 30 years. There are rules and regulations that we need to look at. And that's why you're here. That's why you're listening. That's why you're talking about these things amongst yourself, or you're asking these questions, which is great. And I commend you for it because you do want to do it correctly. So the SBA indicates elsewhere in the loan agreement and the standard operating procedures that you may not use funds to make distributions to owners or repay owners' loans to the company without prior SBA approval. We know many times when we're reading legal stuff, we read the first sentence and we stop and we go, oh my gosh, what? Without prior SBA approval. How do you get approval? Well, call the SBA and say, hey, I need to go ahead and make a disbursement. Here's how much. What do I need to do to get approval to go ahead and do this? Now, many have said, well, is that for the life of the loan? Like for 30 years, I can't pull out any money to myself? It's an economic injury disaster loan. It's to help those that were in dire straits, near dire straits, having a downtime related to COVID. It's not meant to be money on easy street to help you do something different than recover from your economic injury. So remember, the law is the law, not fair or unfair. The law is the law. All right, I am pumped to talk to you about the employee retention tax credit. But the first thing I want you to know is we have some major breaking news. I did a video on it yesterday, the 15th. I went live about it yesterday, the 15th. I'll have some additional, but the infrastructure bill became law on 11/15. Here live with you today. Thank you for joining me, but that was yesterday. So this ends the employee retention tax credit effective 9/30/2021. Oh, hey, listen, JJ's doing this seminar over here. He's got a typo on there. He just said that the ERTC ends on 9/30/2021. Like what's he talking about? We are in November right now. Like, dude, this must be a total misprint here, typo. It's not. The law, many times that comes into play related to taxes is retroactive, and that's what is happening here, unfortunately. So the ERTC is no longer available for fourth quarter 2021. It was available for fourth quarter 2021 until this law. Well, that's not fair. Wait a second. You must have just joined us, because remember, the tax law is the law. It's not fair and it's not unfair. It's just the law. It's kind of like Terminator, right? Terminator is the machine, and it's the machines that have a goal. And what is the goal? To terminate. They don't feel it's not fair. It's not unfair. It's just the Terminator. That is like taxes, okay? So what I want you to remember, though, is that the ERTC is still available for qualified wages and employer paid health insurance paid from March 13th of 2020 through September 30, 21. And you're thinking now, wait a second, JJ, what? You just told me this is over. You just told me that it's not available for fourth quarter. Are you kidding me? What? You're saying I can still get it though? Yes. Because if you have wages that you paid that qualify, plus the employer paid health insurance, between those dates, you still can get the credit on those wages and that health insurance paid by the employer. And we're going to talk about how long you have here, but my point is that you still can get it. It's just that you don't get it any longer on wages and employer paid health insurance paid in fourth quarter. So it's just that fourth quarter no longer qualifies. It's not that the program is dead, and if you didn't get it, you're never going to get it. It's only the fact that it's no longer available for fourth quarter. Now, I do know there's some, based on a few comments, they're like, well, the IRS is going to have to do this, and they're going to have to make sure that we can get that. And then The IRS doesn't have to do nothing but follow the law. Now, what's my hunch? My hunch is the IRS follows the law and says, you're not going to be able to get the ERTC past September 30. And then the next question is, but hang on a second, there are a lot of people, a lot of employers that got that ERTC on fourth quarter wages in 2021. And how'd they get it? Well, they filed a Form 7200 and got the money from the IRS on wages paid in fourth quarter 2021. Or they reduced down their payroll deposit in fourth quarter for the expected ERTC in fourth quarter 2021. That's how somebody could have already got, if you will, the money, the economic value of the ERTC. And you're right, because you're thinking, okay, wait a second, let me make sure I'm following this. The law now ends ERTC September 30. And that was on 11/15. So we're talking like 45 days here, maybe 46 days here, that people were taking advantage of the ERTC. It was a law. They were getting the money. They were reducing down. So what about those people? What's the IRS going to do with that? Well, we need to wait and see, but here's my hunch. It's a hunch. It's a hunch. You know what a hunch is? I don't know how old you are, but I grew up and I had Starsky and Hutch, right? Starsky and Hutch, right? Boom, driving around, what was it? California, maybe San Francisco, in that cool red vehicle with the white stripe. They would get out and then they would walk away from a crime scene and they say, you know what my hunch is? It's a hunch. Here's my hunch, okay? That the IRS will say, you got to pay it back, but we're going to give you a little extra time to pay it back. I think that's what we may see at best, but I don't believe they're going to say, oh, ollie oxen free. Gosh, you got us, man. If you already took it, you already reduced it, you already got the money, well, gee golly, we'll just let you keep it. I don't think that'll be the case. So what do you want to do? Hold on to that money. All right, I've got an executive summary here. Now I'll tell you this, when I was in college, I loved to read anything that was an executive summary. I love to read a book by executive summary. So again, if you want a copy of these slides, go to jjthecpa.com. It's on the seminar page at the bottom. The link is also in the body of this video. So can you take PPP and the ERTC? Yeah, you can. Whoa. Don't whoa me. We're going to talk about it in a little bit, but we're talking about ERTC right now. So I'm not going to go through every single line item with you because this is all encompassing on one page. As you can tell, I tried to make the fonts still readable, if you will, but what we're going to do is talk about each one of these things. But this right here is what I just said. It's an executive summary. So what is the employee retention tax credit? Like, JJ, what? You just went so fast through all that. That's why you want to get the PDF. You can go back and read it because guess what? Here's now the cliff notes of the executive summary. Oh, I like this, right? The cliff notes, not of the book, the cliff notes of the executive summary. So the reason I'm telling you it's the cliff notes is that the cliff notes can't tell you what the person was wearing when they murdered the person. They can't tell you if the sky was blue when they were going for a walk. What's cliff notes? It is now at 10,000 foot to get our hands around what the employee retention tax credit is. It's qualified wages. Okay, so what is wages? Well, for these purposes, it's the employer paid health insurance plus the wages. Together, you add those together and it's a max 10,000 per employee that counts. Now, what? So if you have an employee that makes $20,000, then only the first 10,000 will count in whatever qualified period we're talking about. So if in quarter one, 2021, you have an employee that made 20 grand in that quarter, including the employer paid health insurance, then only the first 10 grand will count towards the ERTC. Now, wait a second, what wages though? I know that I had wages and the health insurance is 10,000, but what period of time? Well, it's called qualified period of time, and that's during a governmental order. And now everybody focuses in on that. And with all due respect to my wonderful wonderful tax profession, but I guarantee if you're tuning into this, you probably do not fall into this generalized statement I'm getting ready to say because you're a CPA, EA tax pro that's paying attention. Clearly, you are doing that if you are paying attention to JJ the CPA's YouTube channel, right? Come on now. But there are a lot, unfortunately, of tax pros, EAs, and CPAs that for whatever reason have said, oh, well, if you had a governmental order, you got to have your gross receipts down too. You don't qualify. Wrong, wrong, wrong. It's either or. So a qualified time period is when there was a governmental order that affected your business. Okay. And in the law, when you read the actual law, okay, when you go to and you think back to the white wigs and all that stuff. I mean, you're in a position and it's back in the day and you're like, what was the law? What was the original law? Well, what the original law is quoted in the CARES Act, it sounds silly, but it says affecting travel or commerce. That's it. It says affecting travel or commerce. That's it. But all to say, in my ERTC seminar, you bet I'm making a plug. You bet I am, because this ERTC seminar will blow your socks off. You're going to get really excited when you take it, when you sign up, because you're going to get a massive amount of materials, but I digress. It's either or, when the government was shut down or the entire quarter that the gross receipts were down. Then you multiply it. Mind-blowing, 70% of the wages and health insurance up to $10,000 per employee, 70% is the tax credit. Each employee, right? I feel like Jack Black in School of Rock, right? And then it's 50% in 2020. So how do you get your money from the IRS? Well, you may have filed Form 7200. You may have reduced down a payroll deposit. All you did was get the money. That's great. But you have to actually report it on Form 941, the wages, the health insurance calculation, show what your credit is. And then if you got some of it in advance, then you would reduce down and indicate, hey, I already got some of this credit. And then you would get the difference. Now, if you didn't get this credit at all, then you would file a Form 941 and get your refund. Now, Form 941, for all the quarters that we would now know you qualify for, given that you don't qualify anymore for fourth quarter 21, the only thing you really could do is a Form 941X. We're going to talk about that here in a second. I got some great news for you on that. Now, what's missed most with the ERTC? First of all, that employer paid health insurance is included. So the 10,000 maximum is wages plus the employer paid health insurance. So what's the most misunderstood with ERTC in 2021? Okay, so the first one is what gets missed. What's the other one that's most misunderstood? That you compare the quarters in 21 to the correlating quarter in 19. You can't see me, but I just did a big yawn right there. Why? Because it's still getting missed. When I talk to clients about it, they actually have to repeat it. Why? Because I make them repeat it with me. I make them repeat it. You compare the quarters in 2021 to 2019, 21 to 19. We were pre-pandemic in 19. So it's very easy that your numbers could be down in 21 compared to 19. So many people think, well, I mean, I was already down in 2020, so I'm clearly up in 21. I'm not going to qualify for that. Okay, well, we're not comparing to 2020, 21 compared to 2019. Now, there is an alternative method discussed later, providing a second way that you can qualify for the first 3 quarters in 2021. So we'll talk about that here in a little bit. So there's even an additional way that you can qualify for each quarter. So when you're determining if your gross receipts are down in 2021, what are you comparing it to? And the entire class said 2019. All right. You know, when I'm in Oklahoma here, everything going okay? You can see me?
Yeah.
Well, perfect.
Video's on.
Okay. Well, awesome.
You look great.
Okay. Well, good deal. Well, I've been staring over here. I got a lake in front of me and a fountain. And as you can tell, I can entertain myself. I can talk to a wall. There's no one in the room right now, and I'm carrying on as though you can see me, but guess what? You can't. So good thing I had my closet closed. And guess what? I even, you see this, I even have my jacket on, and you can't even see me. And I do have pants on. I can't see. I tried to lift my leg. All right, enough of this silliness. Okay, we're talking taxes. We settled down. All right, what's the biggest concern in getting the ERTC if you've already filed Form 941? Because many may feel desperate. Oh my gosh, what? I could have got 70% of my payroll back, a check? You telling me that? How do I get it? Pretty simple, yo. Pretty simple. Form 941X. Wow, that sounds really intimidating. Maybe it is, but guess what? If you got a tax credit for $1,000, how much time would you spend filling out a form to get the $1,000? What if it was a $10,000? How much time would you spend if you were like, you know what, there's 10 grand across the pond that I'm looking at right now, but gosh, it seems really complicated to figure out how to get over there. I don't know how. I got other stuff I need to do. Wrong. You would put everything aside and go, now, how am I going to get that 10 grand? If I got to build a kite that I can float on, I'm getting over there to get the 10 grand. Bottom line is you file a Form 941X. So what does the Form 941X say? You ready for this? Generally, you may correct overreported taxes on a previously filed Form 941 if you file a Form 941X within 3 years of the date Form 941 was filed or 2 years from the date you paid the tax reported on Form 941, whichever is later. What did that just say? You know, it's amazing though, and I say this endearingly, and the fellow tax pros, CPAs and EAs that are on with me right now or watching later, you know what I'm getting ready to say, and you're going to get a chuckle out of it. And it's okay. We get it. That's why we have a job. But what usually happens when somebody starts reading something from something that says Department of Treasury, Internal Revenue Service in the top right, all of a sudden they don't know how to read. What did that say? What's a G, right? I don't know what that says. I don't know if you know this, but IRS instructions are purposely written at a sixth grade level to help them to be understanding. But guess what? You know what? I had to reread that thing plenty of times, and I know how to read English, probably similar to you. And guess what else? The IRS provides all of these instructions in other languages. So even if you can't read English and you can read another language, boom, 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 you still can get this information. So what does that really mean? What it means is if you didn't previously claim the ERTC, you have 3 years from the date the original Form 941 was filed for that quarter. Here's what I want you to hear. 3 years, yo. Or you get 2 years from the date you paid the tax reported on Form 941. Oh my gosh, this is already too complicated. What? There's a word or in there? And it says 3 years or 2 years? Like, which one is it? Guess what? Guess what? No one right now, November 15th, is anywhere near 2 years from when the first possible Form 941 could have been filed last year, which would have been July 31st in 2020, because first and second quarter ERTC was only reported on second quarter Form 941, and that was due July 31st, 2020. We got 2 years from there, boom, right? So yeah, we hit the 1 year in this July. You got all the way till next July that you're the 2 years, but guess what? The above sentence says 3 years or, because the IRS says we get which is ever later. So all you need to know is this. Why does this matter to you right now? Well, how long do I have to get it? Here's what you need to know. You can still get it. You can still get it. Go and get this. This is real money. Now, the next question is, okay, great. I appreciate that, JJ. You've made fun of me about seeing an IRS instruction, and I'll go along with you, and that's kind of funny and everything. But, you know, but when are the 941s due, though? Okay. Like, what are the dates, though? So Form 941 for any calendar quarter is due by the end of the following month. When is that? but real simple. I'd laid it out here. So first quarter, just telling you in general, it's January, February, and March, because these are calendar quarters. Form 941 is due April 30th. Which year is that, JJ? Which year is that? Any year. Go back as far as you want to go back and travel with me as forward as you want to go. It's April 30th. So if you have in second quarter, as example, 2021, you're like, wow, man, thanks, JJ. I love it. I just went back. I got the ERTC from second quarter 2021. Boom. How long do I have to get the money? Well, second quarter, Form 941 was due July 31st. So you have 3 years from July 31st, 2021 to 3 years past that, which would be 2024, right? Plenty of time. So we don't need to worry about this. Go get the money, right? I don't know if you know this, but believe it or not, I'm the CPA here that you've never met one quite like. And I have a song, that's right, on iTunes, and it's called Money Never Sleeps. And in that, I talk about show me the money. So I am showing you the money right here. Go and get it. All right, this stuff's boring right here, so we'll go quickly through it. But it's not boring. For those of you that are trying to dive into some of the details, now I will tell you this, I do a deep dive in my ERTC seminar. These are the IRS notices that are governing the ERTC for COVID-19 purposes. I'm giving you a summary here to know which IRS notice to go to and which one do they apply to. So you got a nice little summary there. Now, in IRS notice 2021-23, don't go blind on me just because I used IRS notice 2123. I'm a CPA. I have to tell you where it's coming from. But it talks about in 2021 that if there's a decline of 20%, you qualify for the entire quarter. So quarter one of 2021, you're comparing to quarter one of 2019, remember? Quarter two of 2021, you're comparing to quarter two of 2019. And then we know quarter three of 21, you guessed it, you compare it to the third quarter in 19. Now, in this is why you need to know IRS Notice 2021-23, and I'll tell you this right now, if you're not a tax pro, CPA, EA, if you email your tax advisor and you say, hey, I was wanting to follow up on something that came across my desk from IRS Notice 21-23 that talked about an alternative method. I want to see if you could visit with me about that. I bet you get a call pretty quick because they're going to be like, you know what you're talking about. And you don't even have to tell them that you learned it from me or that you were informed of this alternative method. What's the alternative method? The alternative method is now ready for us. We're going to get into a spaceship. You're going to be in awe. You're going to not recognize things. You're going to be surprised at what you're being told. It's not going to make any sense, but I want you to do this. I want you to take a deep breath with me. And the reason I want you to take a deep breath is it took me a long time. I scratched my head to figure this out. And the reason why is before IRS Notice 21-23 came out, we were all scratching our heads, but here it is laid out plain and simple. And here's what it is. You ready for this? There's 2 ways to qualify in each quarter in 2021 for the ERTC if the gross receipts are down. Okay. So the spaceship we're in right now is gross receipts are down. The spaceship we are in is we're in year 2021. We're looking at first quarter, second quarter, and third quarter, you guessed it, of 2021. Now, we already talked to determine if you qualify for that quarter, you look at 2021 compared to 2019. Here's the alternative method. You look at the prior quarter and compare it to 2019. And if it's down at least 20%, you qualify for the current quarter. Huh? What? I wrote it out here. So let's just talk about first quarter. Okay, we're going to talk about first quarter 2021. You ready? And it's okay if you want to close your eyes and kind of get into a Zen posture because we need to relax our minds. You ready for this? So first quarter 2021. Two ways to qualify. We're going to compare first quarter 2021 gross receipts to first quarter 2019. Okay. Is it down 20%? No, it's not. It's not down. Okay. So put that aside. I'm using, this is a different sentence. This is a different paragraph. Now what you're going to look at, don't think about what we just talked about. I want you to think now what I'm getting ready to tell you is now forget what we're doing here. Just do this. What are your gross receipts in fourth quarter 2020? What are your gross receipts in fourth quarter 2019? Is that down 20%? Yes. Then you qualify in first quarter. What? Wait a second. What? What you have to remember is we're talking about, do you qualify for the quarter? And how do you qualify for the quarter? Your gross receipts are down 20%. Well, how do I know they're down 20%? Well, you're comparing them from this quarter to a prior quarter. Well, if they're not, then you compare it a different quarter to a different quarter. That's what I want you to hear. Because when you start going, whoa, kind of getting dizzy here, you're saying fourth and then 2020 and then fourth and 19 and then 20, blah. So I wrote it all down for you. What I want you to know is that they've made it easier. We got two ways. All right, this is a different revenue procedure, 21-33. It's the safe harbor. Here's what you need to know. When you're determining your gross receipts, this made it clear that PPP, the grants, the restaurant revitalization grants are excluded from gross receipts when determining your eligibility for ERTC. So when you're determining what your gross receipts are, you don't include those. Now, this one here was huge. This IRS notice 21-49. Why is it important for you to know this? Because this stuff is in black and white. It was beautifully written. The IRS put it out, and these are the rules that we go by. So this is talking about third quarter 21. It's expanding it to include recovery startup businesses. It includes severely financially distressed employers. And it clarifies that full-time employee equivalents are not taken into account. It's just full-time for ERTC. Now, JJ, can we get some more information talking about the recovery startup as well as the severely financially distressed employers? You bet. Take my ERTC seminar. Ba-ba-dum-bum. Continuing, alert. I don't know if you've seen the movie Zathura, but there's a robot that just comes. This is a house that's been ripped from earth, and the house with its dirt underneath it is floating through space, all very realistic. And now a robot comes from the 50s and it's saying alert, alert, alert. Now, why am I doing that? Why am I really making sure that you put the phone down? You told your significant other, hush, JJ's getting ready to tell me something. The kids are quiet, the dog's quiet. Because this is huge. I took a hammer and nailed myself in the head only because that's what it felt like the IRS did with this. Remember, it's the law, not fair or unfair, but what's the timing of the wage deduction? The year that you deducted the wages, if you got a credit on those wages, then that's the year you reduce down that deduction. We talked about it earlier, but it basically is defined in here. Now, what does that mean? What? We talked about it in the big questions. You go, oh my gosh, I can get a credit from 2020. I got to go file a 941X. I got plenty of time. I got the credit on the wages that I paid in 2020 during the qualifying period. Boom, I'm going to go get me that credit. I'm going to file me a 941X and I'm going to get me that money. Yes, you should. But remember, whatever you get of the ERTC reduces down your wage deduction. Well, what year? Now, logically, it would be the year that you get it. I mean, that's what I thought until this thing came out in August. Seems logical, right? Well, what year would I reduce down the wages? I would reduce down the wages when I got the actual credit. Wrong, IRS says. If you got a credit, let's say you filed a 941X today because you got excited and you went after my seminar, and you got yourself an ERTC 941X on 2020 wages, boom, you're sending it in. most likely, and pretty much a certainty, you're not going to get that credit, that refund, that check until 2022, given that we're at the end of 21. Well, when are you going to report that credit? When are you going to reduce down wages? It seems logical it'd be in 2022. IRS says here it's in 2020. It says right here that you even need to amend your return. So FYI, now, is that a reason for you to not go and get it? Nope, because 2021-49 also gives you penalty relief, So go get that credit. That's not a reason to not go and get it. Now, what about related individuals? Now, I'll tell you this right now, in my community of tax pros and EAs and CPAs, right now, there are guns drawn. The knives are out. We're at high noon. JJ, you getting ready to tell me something I don't want to hear. So why don't you just shut her down? Because what you're getting ready to tell me is different than what I did, and I don't want to hear it. Okay. Then cover your ears, because IRS Notice 2021-49 went out of its way to show you that the sky is actually blue on most days. Okay, meaning they pointed out an obvious that was already an obvious when the law came out. Well, it wasn't an obvious because I took advantage of it. What am I even talking about? ERTC wages on related individuals as well as the owners. And we're talking about owners that own more than 50%. Go to IRS Notice 21-49 on pages 30 through 31. And what I'll do is when the seminar's over, because when we go live through Zoom, we only have a few seconds to put the stuff in the body of this video. I will give you links. I'll make note of it right now. I'll give you links to these IRS notices. Why? Well, because you've never met a CPA quite like me. So IRS notice links, okay? But there's examples there that are going to blow your mind. And the IRS did a phenomenal job with these examples because it's pretty hard not to understand them. And what you need to know is this. If you or your client has no lineal heirs, then they can qualify for the ERTC on their own wages, even if they are more than 50% owner. What that means is, unfortunately, this would be someone that is all alone in the world. They then would qualify. So if you're not all alone in the world, you have a son, you have a daughter, you have brothers and sisters, you go to 267C, what does that say? So if the majority owner have no brother or sister, whether whole or half, ancestor or lineal descendant, as defined in 267C4 of the code, then they qualify. So that's not very many of us, thank goodness. Okay. So I have a brother who's half-blooded, lives in California, doesn't work for me, not an owner, right? Because I have a brother that's half-blooded that lives in California that has nothing to do with my business, I don't pay them, they're not an owner, ruins it for me to be able to get the employee retention tax credit on my wages because I am more than 100% owner in my business. All right, also it talks through some things that are kind of boring, right? Some COBRA and talking about the health insurance and things to that effect. So what I want you to do on 21-24 is go back and look at the penalty relief. Okay, in 21-24, penalty relief. Where do I find the penalty relief, JJ? IRS Notice 21-24. What penalty relief? Getting too much ERTC that you have to pay back, amending returns, things that are related to this. So go check those out. I'm not going to go through all the details. I'm just telling you where to go, because if you get a penalty notice, it is not time to go hide your truck. The IRS is not coming after you, okay? Unless you like ignore them for a long time and you're evading them and you're breaking the law. What you need to do is when you get an IRS notice, take a deep breath, open it up. It's in black and white. It's written in English. They probably could translate it for you if need be. And I say that in all seriousness. And if it has a penalty in it, what is the dollar amount? So I'll tell you a quick little story. Had a client, bless their heart, showed up at our office mid-afternoon on a Friday in a panic, literally out of breath. I need to meet with JJ right away. Where's JJ? I got to meet with him. I don't have an appointment, but I got to meet with him. I mean, literally, I'm not even exaggerating. Come back like, hey, such and such is here. They are in a panic. So of course I got up and I went out and I was like, hey, what's going on? He's like, I just got this IRS letter. They said that they're going to levy my assets. And so I don't know what to do. And so I got this letter and I immediately drove away from my office, and I'm here and there's no one that knows where I am right now, but they can't come get my truck. I give you zero exaggeration on this, not even with the tone. I said, okay, well, let me see the letter. What are we talking about here? It was a $127 penalty. So I looked and didn't break face. I didn't laugh at him. I didn't make fun of him. And I said, well, can I ask you one question though? Do you have $127? Yeah, literally. I said, well, you can do one of two things. You can either pay this thing, but if they're going to levy you, they're only going to get $127. And you got your first notice. This was all done 30 days ago. They're not going to come levy. And if you read the details, they're going to levy any state refund you have if you don't pay this within a period of time. Here's what I'm trying to tell you. Why did I tell you this story? Because I am a little aggravated when I learn how many penalties are paid by Americans that were not correct. And here's why. Here's why those penalties get paid. Well, oh my gosh, I don't want them on my back. I don't want the IRS to know where I'm at. I don't want them to, think that I'm going to be a tax dodger. I don't want to get audited. I don't want to get audited. That is assuming that you are being federally investigated, that they know anything about you. That would assume that you are breaking the law, you're a criminal, you're a gangster, right? That you are literally actively doing things to break the law. Does the IRS know anything about you or even care? I hate to break it to you. The IRS doesn't actually care because it's a computer that generates a letter providing the penalty. And what's a computer? It's like the Terminator, like I told you earlier. The computer does what? It's a calculation that spits out from the software. Here's the penalty. And many, many, many times the penalty is not correct, especially related to things with payroll taxes related to these credits, as well as those that are getting tax credits and they're having to amend returns. So don't pay a penalty thinking that somehow you're now a winner. Somehow you've done something that's good and they will not come and talk to you again, because that has nothing to do with nothing. Nothing to do with nothing. Don't pay penalties just to pay them. Now, you may have somebody and they say, well, I got a penalty for $14 and it's not right. Well, some people want to fight it. Some people go, well, it's $14, it's not right, but I'm going to pay it so I don't have to pay $300 to my tax professional to go ahead and fight this. I get that, cost versus money. What don't I want you to forget? I don't want you to forget. We're going to wrap up ERTC here. I don't want you to forget that ERTC is retroactive to any wages paid after 3/12, which means that any wages on 3/13 and after are going to count. The other thing is that the ERTC is still available for any wages or health insurance that you paid 3/12 through 9/30/21. It's still available. Yes, the law changed that it's no longer available for fourth quarter, but that means it's no longer available for wages and health insurance paid in fourth quarter, but you still can go back and get these and you still qualify. The other part I don't want you to forget is that the amount of the ERTC does reduce down wages in the year the wages were deducted, not when the credit was received. So regardless of how you go about getting the actual ERTC, you must report these wages and do the calculation and the health insurance and figure out your credit on a Form 941. And if you didn't do that, you got to do it on a Form 941X. And for whatever reason, there are a lot of dodos out there that have something to do with payroll. And the reason I call them dodos is that they think that if you file the Form 7200, you're done. And anybody that's helping you with your payroll, and they said, oh yeah, if you file the 7200, we're good. We don't have to report anything on the 941 is a dodo. Run from them and find yourself a professional that actually knows what it is that they're doing. Because no matter what, even if you got the credit by filing a Form 7200, which is just something faxed to the IRS that says, I need some money, I qualify, you don't tell them on that form how you qualify. You don't do a calculation on that. All you put is a number. Why am I telling you all this? Because even if you file a Form 7200, you may have felt like you did something, but you didn't do anything other than request some money from the IRS. On the Form 941 is where you reconcile everything. So what I want you to do, because if you don't, you could lose the credit, have to pay it back with penalties and interest if the IRS comes to you after the statute of limitations, which they can, and says, wait a second, whoa. You never reported the employee retention tax credit. So the statute never ran for us to be able to question it. So the statutes run though for you to get a refund, right? 3 years. And sorry, you're going to have to go ahead and pay this back. So what do you want to do is this. Pretty simple, even if you don't know what a Form 941 is. It's a form that at the top says Form 941. And when you look at it, even if you don't know what you're looking at, there is a line item. Just look at it slowly. There's a line item that says employee retention tax credit. Where is it? It's on Form 941. Just go through it slowly. You'll see it. Employee retention tax credit. I'm having fun with you because so many times we don't take things into our own hands because it's on an IRS form. And we think we don't know anything about it and we don't know what we're looking at. I'm telling you, make sure that if you took a credit, look back at the Form 941 that was filed and ensure that it was actually reported on the Form 941 to make sure you don't get yourself in a bind later. And if not, guess what? Real simple. You just file a Form 941X. We're going to talk about PPP loans, but guess what? We're talking about how it mixes with ERTC. This is key. This is key. So many people, and it just bothers me, and including my wonderful, beloved tax professionals, EAs and CPAs, which none of you are on, so I can talk about these CPAs and EAs and tax pros because they're not on here. They're not listening to JJ the CPA. But what we hear a lot is, well, I got PPP, so I don't get ERTC. Wrong. I mean, it's so wrong. It's wrong. Okay. Pick something that is wrong and absolute wrong that you know in your life wrong, and that would be now on your list. You can get PPP and ERTC. What's the key is you just can't get it on the same exact payroll. So biggest misconception is when you're calculating PPP loan forgiveness together with the ERTC that you're not able to get both. You can. The key is you can't get it on the same wages. What does that mean? Well, if you have someone and you pay them $10 an hour and they only work for you for 1 hour, that's it. They came, they worked for an hour. You said, get out of here. You're no good. Done. But you paid them $10. It's on a W-2. It's $10 in payroll. Okay. Well, that $10 for that hour, guess what? You can use it for PPP or ERTC. Or is the key word, or. Okay. So if you use the $10 and include it in the wages you're using to get PPP forgiveness, then you don't get to include it in the wages that you're using to determine the employee retention tax credit. And it doesn't matter the ordering. It could be coincidentally, which probably would be the most rare ever happening. Let's say that you got PPP on April 1st, which is impossible in 2020 because it wasn't even available then, but just follow me. April 1st, 2020, you got PPP. And oh, by the way, I qualify for the ERTC in second quarter 2020. So On the same day, my quarter begins, and I also got PPP. Not at all is it, will I use PPP and then the wages after that are ERTC. And what I hear the argument of, which quite frankly is usually the ones that would be saying in the times when tigers were eating people for play, and we're talking about in the Roman times, and the crowd would yell, yeah, but I heard. Okay, what are we talking about? We need to stop saying, yeah, but I heard. What we need to do is go, well, what does the SBA say and what does the IRS say? What's in black and white? Doesn't matter what you heard. Doesn't matter what you think. It's what is it? And what I'm telling you is right now, when we look at the IRS and the SBA, okay, we're going to break it down. We're going to look at both. So per the SBA, they specifically state right here, black and white. Well, where is it? Well, it says, do not include wages taken into account in determining the employer retention credit. So where do we find that? Well, there's a form 3508S, look at page 4. There's a form 3508EZ, look at page 6. The 8, look at page 10. There's an interim final rule, look on page 58 and 59. And it says that any wages that you use for ERTC then don't qualify for PPP. And then you go, yeah, but JJ, you know, it's not right. You're telling me I can use PPP on wages and get ERTC? And I'll say, hey, Huckleberry, get your lantern and let's go around the corner because it's daylight over there. You're still in the dark. And the IRS does a little easier job explaining this to us, which is the same thing the SBA is saying. And this is directly from the IRS release. I didn't rewrite this. This is directly, quote, word for word from the IRS. Go to it. If you take my ERTC seminar, yep, it's a plug. You have a link to any and all of these things with expanded information. But it says this, an eligible employer can claim the ERC on any qualified wages that are not counted as payroll costs in obtaining the PPP forgiveness. That's the same thing the SBA said. The IRS helps us really understand this because it says any wages that could count towards eligibility of the ERC or PPP can be applied to either of the two programs, not both. What does that mean? So that person that worked for an hour and you paid them $10 and it's going on a W-2 and they were paid on April 1st and oh my gosh, that's the day I got PPP and that's the day the quarter begins that I can get ERTC. Do I have to use that $10 for PPP because that's when I got PPP? No, it's saying if that's a qualifying wage on April 1st, $10 to that employee, well, if it qualifies for ERC because you're in a quarter that it qualifies, if it qualifies for PPP loan forgiveness because it's during your covered period, it qualifies for either. So take your pick. You just can't use it for both. Now, the big thing I want you to remember, and I go through this in detail in my seminar, there's just not time to go through it with you, is I want you to remember this. The PPP forgiveness is a 24-week period. It's almost 6 months. What's almost 6 months? 2 quarters. So it is very likely that in the example I just gave you, that if somebody qualifies for the employee retention tax credit in second quarter, and they want to use all the wages they possibly can for the ERTC, they can, because from April 1st plus 24 weeks is the covered period for that employer to then use it on payroll, which means that in the third quarter, that person could be using the payroll paid at that time for the PPP loan forgiveness purposes. There's no ordering. The other thing I want you to know is this. How much for a non-owner of wages count for PPP loan forgiveness purposes? $46,153, not including employer paid health insurance, is the amount that can qualify for each employee to achieve PPP loan forgiveness. That's the max. What is that? Well, it's 100,000 is the max annual that could count, divided by 12 times 2.5, 46,153. That is way more than what qualifies for ERTC. So let's just go with this. You have a business and the only employee is a non-owner. And that employee is paid all year. And they're paid $100,000. And this person got the PPP, and what would they have gotten? If the annual salary, the only employee, is 100,000, what would they have gotten? Well, it would be 100,000, the salaries, assuming they were the same in 19, divided by 12 times 2.5, which is what? 20,833. So the maximum this employer got with one employee that has 46,000 of 153 of covered period wages that could qualify, also in my example, qualifies for second and third quarter of the ERTC. You ready for your mind to be blown? That one employee for that employer, assuming they're paid the 100 grand on an annual basis, they're paid the 46,000 during the covered period, would allow that employer to get 100% full forgiveness for PPP. Huh? What? Huh? If that employer paid 46,153, which is the max, which is what that employee would have been paid in 24-week period, if that person was still, in essence, making the same as the prior year, 100 grand, then the first 20,833, assuming they just want to use all of the payroll that they possibly can for forgiveness, would be used. So we don't even have to really even do the math there, because 46,000, right, minus almost 21,000, right, we're left with 25,000 in payroll that can be used for the employee retention tax credit. So for those of you that want the exact numbers, 46,153, and we have then 20,833, $25,320 left of payroll not used for PPP loan forgiveness. And most likely that 25,000 would be roughly about 12,500 or so, right? Because we know payroll can be by the week, not necessarily by the quarter. But there's going to definitely be, of 20,000 left, 10,000 in payroll in second quarter and 10,000 in third quarter for this employer. And so then this employer can use the wages not used for PPP loan forgiveness for the ERTC tax credit, and therefore this employer can get that maximum amount. Okay, so that's under the 2021 rules. So we know people got PPP in 2021 because it's 10,000 per quarter, 10,000 of max wages for first, 10,000 for second, and 10,000 for third. That's wages plus health insurance at a max 10,000. Now we know in 2020, okay, if we're now back to 2020, the maximum that counts is 10,000 of wages and health insurance at 50% for the entire year. So if we're back in 2020 and that person under the same exact circumstances, they can use 20,833 for PPP loan forgiveness. There's still plenty of payroll left that could qualify for the ERTC credit, assuming they qualify otherwise, and they get the max. They get the max. Now, one of the things that I've gotten a lot of questions on, which I love, is does the PPP loan forgiveness increase basis? Okay, I'm off the ERTC and PPP. I'm talking about PPP loan forgiveness increases basis for what? For taxes. Okay, so this is something that is really for tax professionals to maybe really kind of grasp, because I'm really giving an overview summary here. But the thing I want you to know is that it doesn't increase your basis overall. What does that mean? Well, PPP loan forgiveness, right? That means that money was spent, it was deducted. That deduction reduced down tax basis. The tax exempt income increases the basis, so there's a zero net effect overall. So the Consolidated Act specifically provides for this word for word here. That's what came out at the end of December. What I'm telling you is when you hear, well, does PPP loan forgiveness increase your basis? Technically, yes, but the deductions reduce your basis. Therefore, it's a net zero overall. All right, qualified business income deduction. Okay, we're wrapping up, going into major issues here. Okay, sharpen your pencils now because we are pretty well past the PPP, the EIDL, and the ERTC, and how the ERTC works with the PPP. Okay, we're talking about some tax update stuff. The qualified business income deduction is the single best deduction that has hit small business owners in the history of small business owners in the history of the world. What is that? It sounds really complicated, JJ. It is, but I'm going to simplify it. Because what is this? Basically, it's this. You take your net income of your business times 20%. It's a deduction out of thin air. Literally, you can make that sound when you see if you have something on line 13. So all you have to do is pull out your Form 1040 from 2020. And did you get this deduction? It was available in 18, it was available in 19, it was available in 20. Now, one of the things I'm going to tell you, if you didn't know, on Form 1040, the line items change every single year because the laws change every year. So it's not going to be line 13 necessarily when you look at 18 or 19's tax return. But what you want to do, and maybe you're scrambling right now, and by golly, you should, and make sure you got this deduction. How do you know? Is there a number on line 13 of your Form 1040? Because if the answer is yes, then you got the qualified business income deduction, hopefully correctly. Now, what does that really mean, JJ? What are we talking about here? So on active businesses, you take a Schedule K1, you go to box 1, right? And if it's active, times 20%, that's your qualified business income deduction. What's the net on your Schedule C? What's the net on your Schedule F? Times 20%, and that's your qualified business income deduction. Hopefully what you're gathering here is that you didn't spend a dime. What's your net income times 20%, that's your qualified business income deduction. Now, I teach this around the nation right after it first came out. So I've been teaching this in 18, in 19, and in 20, and in 21 to certified public accountants, enrolled agents, and tax pros. And I probably have presented this, let's just count it up. I probably have almost 600 hours worth of presenting seminars, and this has been a big part of it. And here's what I want you to know. It can get phased out if your income's too high, if you're in a service trader business, right? If you're not active, if it's not a trader business. So you're right. There is more to it. There's a Form 8995 and a Form 8995A, as you can see there on the description on line 13. But let me ask you this. If I came to you and I said, hey, I give you a free tax deduction, you're like, well, that's too complicated. I don't even want to look at my Form 1040. I don't know. I mean, it scares me and it makes me nervous. And, you know, it's almost the holidays and I need money and I don't want to think about taxes and a Form 1040 scares me. Well, guess what? You don't have to be scared. Look at line 13. Is there a number there? Yes or no? And then it's real simple. You follow up with your tax advisor and you don't be snotty about it. You don't say, hey, I was watching somebody on YouTube and they said I should have a number on line 13. What you would do is contact your tax professional very professionally and just say, hey, you know, learn something about this qualified business income deduction. I'm looking on line 13. I don't see a number there. I'm sure you did it correctly. Is there a time we can talk? I just want to better understand why I didn't get the deduction. And they may email you back and go, well, you didn't qualify because of XYZ. The other thing is if you don't want to do that because you're scared to contact your advisor that you're paying for whatever reason, because it's complicated, or I don't want to pay them because I don't want to pay them $45 to tell me why I missed a $25,000 deduction. That doesn't make any sense to me. Pay 45 bucks. Maybe I could have got a $25,000 deduction. I'm of course being facetious. But in your tax return, you just have to keep thumbing it or keep scrolling and keep scrolling. And you're going to come across a form if you think you should have got it, even if there's not a number there. But there's a form 8995. How do you know what form it is? Because at the top it says form 8995, 8995. I'm having fun with you. And if you see some numbers on there and some descriptions and some calculations, like, wow, all right, well, I mean, they obviously did the calculation here. It resulted in a 0 because I made too much money, or I'm not active, or I had other losses that offset it. You bet it's complicated. I'm not simplifying that at all. But what is simple this, and there's many tax professionals, they can't get this through their head, okay? The qualified business income deduction is 20% of your net active business, trader business income, period. That is the qualified business income deduction, period. How much of that is allowed is what shows up on line 13. How much of that is allowed? Here's my point. It's the biggest tax deduction ever. I have clients that it's saving them $40,000 a year. It's deduction out of thin air. Make sure you're getting this. Well, I use the software, so I'm sure that it did it. Well, my person's been around a long time. I'm sure that they did it. Great. Glad that you are on the roller coaster in the dark and you totally trust that there's going to be a continuation of the track. Why won't you just pull out your form 1040? Why don't you just look at line 13 and verify that the person that you know and trust, verify that the software that you trust did it? Because guess what? Tax returns are complicated. I don't know if you're aware of that. They're complicated. So be aware of what happened. Qualified business income deduction and the COVID stimulus. Whoa, hang on. You already told us about PPP and the ERTC and the EIDL. Why are we talking about it again? Well, because we're now talking about the tax aspect. So when you're determining the qualified business income, that's the trader business income. That excludes PPP loan forgiveness, forgiven or not. It excludes the EIDL grants, whether it's supplemental or the targeted. It excludes the EIDL. Well, it should because it's a loan. It does include the taxable other COVID-related grants. So there were state and city and county grants that were paid out. Those are taxable. That is included. It does include the family and sick leave tax credit, which is counted as other income. And it does include the employee retention tax credit because it reduces down the wages. So when you're looking at your taxable income from your trader business, these are all things that are included. What are some other developments on taxes as we wrap up here? Don't forget, in 21 and in 22, you get to deduct 100% of business meals, right? So food and beverages from a restaurant. So in 21 and 22, you get to deduct 100% of that. Previously, it was 50%. After 2022, it goes back to 50%. So for these 2 years, the one we're in and the next year, we get to deduct 100% of business meals. It's still 0 deduction on entertainment under the business. So you can check out that notice if you want to go through any other details. Now, here's a big one. Here's a big one. Everybody's forgetting at this one. People are asleep at the wheel, potentially, hopefully not. They are asleep at the wheel. When the CARES Act came out, it had a provision in there that employers could not pay in their portion of the Social Security taxes on their employee wages. What? Huh? What are you talking about? So the CARES Act said, hey, employer, if you're strapped, even if you're not, here's what you can do. When you pay your employees, the Social Security tax that you have to match, so 6.2%, of course, we know it maxes out, but you don't have to pay that in yet. You got to pay in everything withheld from the employee. You got to pay in the Medicare taxes that is the match, but you can defer what is due and you can pay half of it through the end of 2020. And then you can pay half of it by the end of 2021 and the other half through the end of 2022. If you don't pay it, you got penalties and interest, probably pretty big time. So hopefully that's been tracked. Hopefully you're aware of it. but you got to be aware that it's due by December 31st. How do you get it paid in? Through a payroll deposit. Check with your payroll company, because if you were having taxes deferred, even if you're like, well, I don't know if I was or not, contact them. Say, hey, did I have any deferral of payroll taxes under the CARES Act? They'll be blown away that you just said that. It's okay if you told them you heard it from me. Part-time workers, retirement savings. This is huge. So the Secure Act, okay, it came out at the end of 2019. And in it, it provided a provision that for years beginning after December 31st, 2020, meaning it starts in 21, that part-time employees get to be included in retirement plans under the 401k. So I've laid out for you how in the provisions, but if you have part-time employees, you start looking at when they become eligible to be included in the 401k, including with the match. Partnerships, there's Schedule K1s and S Corp K1s. What I want you to know, the biggest takeaway I want you to know is that they are required to be reported on the tax basis when you're talking about the tax basis. What are we talking about? Well, whatever the business's accounting method is, if they're cash basis or accrual basis, what the IRS says is no. You got to report tax basis. So money in, money out, income and losses that reduce, you've got to report it on the tax basis. If you're scratching your head on this, that's okay, because the seminar is also for those that are familiar with taxes. And as I said at the beginning, some of these things, I'm not going through it A through Z. We don't have 640,000 hours. I'm just giving you what we need to remember, because this is what went into play in 2020. Many people forgot. Now on the S Corp, Schedule K1, there's a new Form 7203 coming. I contacted the IRS agent that they told us we could contact to see if we could get a copy of the form. They politely and very responsibly let me know that it's not ready yet, can't get it, but there's a form that's tracking the basis. What is the basis? Well, it's knowing whether or not you can take losses. What is the top major numbers not to miss when doing your final 21 estimated tax payment calculations? Remember this, the excess business losses are back in effect for 21. What is an excess business loss? It's losses on your return that are in excess of 500,000 married filing jointly, or in excess of 250,000 single. So for business owners, you have a loss, it's 600,000 married filing jointly. You're only going to be able to deduct 500,000 of it, and 100,000 of that loss is going to carry over to next year. That was the law in 18, 19, and 20, but the CARES Act said, you know what, we're going to wipe that away from 18, 19, and 20. There will be no limitation on losses as it relates to excess business losses. Now, there may be limitation of losses because of passive activity rules or tax basis or at-risk basis, but the excess business loss, in essence, limitation on how much losses you can take, not in play. Now they're back in play in 21. So don't be caught watching the paint dry on this and go, oh, I got big old losses. Well, they're going to be limited in 2021. Also, we know there are the limitation on the NOLs. What are back in effect is that any NOLs in 21, they can't be carried back. So if there was an NOL in 18, 19, or 20, it could be carried back. That's what the CARES Act allowed. It could be carried back 5 years. There's some rules here related for farmers. The NOLs still carry forward. The one thing I want you to know is that if you do have a net operating loss, an NOL, that means you had a suck year, you had negative income on your tax return, and I'm sorry that happened. But if you have a net operating loss, that means your losses were so huge that you get to carry over those losses into the following year. Well, if you have a loss in 18, 19, or 20, it can offset 100% of future taxable income. Now I'm talking on the individuals here. If you have an NOL in 2021, it carries forward indefinitely, but it will then only offset 80% of taxable income. Now, what's most probable? I want you to hear it's probable, okay? So per the House Finance Committee latest draft, HR 5376. Now, I will tell you this, I've been practicing, as you know, going on 28 years. When we hit January, I'll be 29 years. technically going into my 30th. What I'm telling you is probably for the first 26 years that I've been doing this, I never paid attention to what was going on in Congress. Never paid attention to the politics of who was doing this and who was passing this. But we've all learned in the tax industry, going back probably, I don't know, 2015, when we had some retroactive tax laws. We do need to pay attention to this because more and more tax laws are being changed near the end of the year with very little time to be able to react to them. Now, what many have heard is that capital gain rates are going up and there's going to be estate tax issues happening and an effect on that. Well, what's out of the House committee actually doesn't include anything related to that. What are the big things that it does include? Now, this is unknown, the date of this seminar. Why is it unknown? Well, because it's possible. It's in a draft. It hasn't been passed, hasn't gone through the Senate, and it certainly hasn't been signed into law. So why are we looking at this, JJ? Here's what I want you to see, okay? Stick with me. Here's what I want you to see. This is important. This is huge. This is the biggest thing that you're going to see that affects more people than we all think. Because what we hear is that the tax rate at the top level is going to go to 39.6. And then typically you're like, yeah, well, they're rich. They can pay another 2.6. Okay, maybe they can. But what I want you to note is this, and you're right, you're looking at numbers, your eyes are going blurry right now. What does this all mean? I don't know. Here's what I want to tell you. See where the arrows are pointing? Okay. So currently 21 tax rates. If you're single and your taxable income is over $523,601, then the taxable income above that is taxed at 37%. Okay, it doesn't even matter what the other columns say. If you understand that, you're going to understand the other columns. It means that any amount above that is taxed at 37%. Okay, married filing jointly, $628,000. Any income above that, taxable income, right? Taxable income is taxed at 37%. So when we get cynical and we go, it's just going 39.6 up 2.6, it's nothing. Okay, but guess what? What's being proposed right now and what's pretty much in the House bill is that we get into that new tax rate a heck of a lot sooner. So when your income as a single individual is over 400,000, ding dong, the witch is dead. Your tax rate is 39.6%. You're married filing jointly, your income's over 450. You bet that's unfair compared to the single, but nonetheless, your income's over 450. You're paying 39.6% on that. So it's not just that the tax rate went up 2.6. It is that you're looking at 175,000. Well, it's like, you're a CPA and you got to use a 10 key. You bet I have to use a 10 key. You know why I use a 10 key? Because I bill by the hour. Okay. I'm not supposed to do math quickly in my head. I can't bill as much. I got to do this. I got to have a 10 key tape so I can tape it and show you what the math is and then make sure it was done properly. So 178,000 quicker married filing jointly, you're paying the 39.6% rate. That's a big difference when we look at that, and it's going to just trickle down. Whether it's fair or unfair doesn't really matter. It's just the law. What are the possible tax law changes? This one's mind-blowing. No one's talking about it. I don't know why, probably because it's in the House, but this is what's at the CBO. This is what's being looked at. This is what's part of what's called the Build Back Better bill. I didn't name it. That's what it's called. Okay, HR 5376 is this, and this makes up a huge amount of covering the cost of Build Back Better bill. Is the 3.8% tax imposed on S Corp and partnership Schedule K1 income. Now, if you're a tax pro, an EA, a CPA, your ears just went up if you're sticking with me. So we're into the evening. If you're cooking dinner, just pause for a second. Okay, just pause for a second. Right, you're at the dinner table with the family. Hello, family. Hang on a second, Junior. Whether that's a woman or a boy, okay? Just hush. You heard it correctly. This is huge. Doesn't matter that it's 3.8%. Okay. 3.8%, we already know is in existence. It's the net investment income tax. Okay. It's called many call it the Medicare tax on other income. Many call it, and this is just what they call it. I didn't make this up. It's what they call it. Many call it the Obamacare tax. Okay. Not trying to be political. It's just look it up. That's what people call it. Nonetheless, pick your name. It's a 3.8% tax that did go into play. And currently 3.8% is a tax imposed on anybody that's got income over 250,000. I'm not talking about gross. I'm talking about on your income, on your tax return. So your income's above the 250, then interest and dividends and capital gains and passive income. So passive Schedule K1s, passive activities on Schedule E, those are subject to that 3.8% tax. This is mind-blowing to hear this, but whether you're active or not, this 3.8% tax would be imposed on Schedule K1 income, most notably Box 1 of that Schedule K1 from a partnership or an S Corp. Not no, they're passive. No, they don't materially participate. It's not subject to it. Current law, you're correct. This law imposes it. The reason I think this is probable, and I mean extremely probable, is that they have scrapped anything about an increase in the capital gains tax rate in terms of the draft. They have scrapped anything related to the estate tax. And what they've zeroed in on is this. And the Tax Foundation, which is a nonpartisan group, did an analysis on this. So just go to Build Back Better, HR 5376, Tax Analysis, Tax Foundation. You'll find it was written here recently. But they do a beautiful analysis of just showing factually a calculation. There's no politics involved because it's math. And they look, and it is billions that is then coming into the government from this tax. Doesn't matter if it's fair or not fair, it's just the law. And what's coming into play is this 3.8% tax. Now, I'll tell you what's interesting, because I have actually literally read the draft 5376 related to these tax provisions. I haven't read the whole thing because I think it's over 2,500 pages. But what's interesting is that it literally says, and I don't know in the history of me reading tax law that I've ever read anything like this in tax law, but it literally says that this law is not to affect those that make less than $400,000. And it says that they will, in essence, empower the IRS to do what it needs to do in the calculations to ensure that that happens. So what I want you to know is on this 3.8% tax, what it seems likely is that this on non-passive income, this on Schedule K1s that they materially participate, that it would be on the overall income if it's over 400. Now, the thing is, the 3.8 currently is on income when it starts to be over 250. So we'll have to wait and see. The thing that you want to know, and it's okay, you can tell Billy and Sally, kiddos, go ahead and eat again. You can start eating again. You can start cooking, right? Make sure you have your oven mitts on if you forgot that you have something hot in the oven, because I know your mind was blown with what we just talked about. But nonetheless, what I want you to be aware of is this is coming. And here's the bad thing about this law change. There's nothing we can do about it. So with this law change, I'm going to go back a slide. When the tax rates go up, and this tax rate here is already in existence, it's just applied, there's not much we can do about it other than be aware of it. It's not a way to get out of it. Now, you could say, oh, well, I know, I'll just make less income and it won't be imposed on me. But I want you to hear you say, well, I made less income. So another way to look at this is this, and this is my overall when we're talking about tax planning, is if the tax rates are higher next year, which means that you would be in a tax bracket sooner. Because the reality is when you look at the 10 and the 12 and the 22 and the 24 and the 32 and the 35% tax brackets, those aren't going to just stay the way they are, right? Those are all going to change. And most likely history serves that when the tax rates change at the top level, then the brackets, if you will, meaning when does the income get into these tax rates, also changes. Taxes are going up, right? And we have this additional tax that could go into play. And why is that important? Because you just said there's nothing we can do about it, JJ. Why do you keep talking about it? Well, because when we're doing our year-end tax planning, which you should be starting now, and hopefully you're going to check out my seminars. I'm going to have a year-end tax seminar as well. But when you're doing your year-end tax planning and you're doing real tax strategy, okay, the first thing you do in tax planning is figure out what was my income last year and what was my tax last year, because then all you're trying to solve this year is what's the difference? Am I up? Am I down? And I talk about it in my tax seminar in doing tax estimates. But if you're up, then you know what? Your taxes are going to be more in the prior year. How much more, JJ? How much are you up? Take it by a third, right? That's just finger in the wind. Just finger in the wind. Call it a third. Settle down for those of you that are like, wait a second, there's different tax brackets and blah, 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 blah. Just settle down. Because we're talking about estimates. We're talking about, do you owe $100,000 or $1,000? But you go, okay, I'm looking, and last year, compared to this year, my income is going to be up 100 grand compared to last year. Now, I'm not talking about the gross. I'm talking about your taxable income. And many times with small business owners, they're hard to know, well, what's my net income? Well, have a good set of financials for starters to know what your net business income is. And what was that net business income? Pull out your tax return, Form 1120S for S Corps, your Form 1065 for partnerships, pull out your Schedule C, pull out your Schedule F. Guess what? They're numbers that you learned in kindergarten. I'm having fun with you. What was the net in 2020 on the tax return? You should have it by now. Where is it? Find it. What's the net? What's your net now? And guess what? That's just through now. Is it up? Is it down? If it's up by 100 grand, you owe another 30 grand in taxes, give or take. Well, wait a minute, but I'm not in that high of a tax bracket. I don't think it's going to be 30 grand. Well, it's going to be more. Your income's up 100 grand. It may not be 30,000 more you're paying in taxes, but it's going to be more. Well, how much is my total tax going to be? Guess what? What was last year's tax? Find it. There's a line item. It's called total tax. You'll find it. It's right on there. Total tax. And I'll tell you this, even for tax professionals that probably already are like, hey, great job, JJ. This is good. You're kind of getting down into stuff I already know. You know, come on. It's baffling, to be honest with you. And I guarantee, I should digress. If you're on here, you're not saying that. But it is baffling to me, sitting across from CPAs over the years, EAs and tax pros, that when I talk about this concept, they're like, what? What was your tax last year? What is your income going to be up by this year? Times a third, rough number, and add them together, huh? If your income's up by 100 grand this year, then your tax is going to be probably 30,000 more. 30,000 more than what? Than last year's taxes. So I take last year's taxes plus what more tax I'm going to have this year tells me my total tax. And now you're going, okay, now what can I do about it? And that's what's called a strategy. Now we're talking strategy. Because if we know the rates are going to be up going into next year, not just by 2.6, but by getting in those higher brackets quicker, knowing that potentially you're in the 3.8% additional tax, right? You start adding these things up, 3.8, right? And 2.6, another 6.4% in taxes. Well, that's not a lot. Okay, on 200 grand, that's like another 12 grand. Go and tell your grandkid and go tell your kid that 12 grand's not a lot of money, because you would tell them 20 bucks is a lot of money, right? Why does that come into strategy? Well, tax deductions are potentially going to be worth more next year, meaning a tax deduction this year versus next year. Next year, it's going to save you more tax because if the tax brackets are higher or you have a new tax, a tax deduction saves you another 6.4% in theory, right? Well, JJ, I mean, this is a pretty complicated stuff. Exactly. And that's why you want to have a tax pro involved. This is why you want to have an EA. This is why you want to have a CPA. And guess what? Typically what happens is you lay down when you hire one and you're like, oh, I got somebody, I don't even have to worry about it. Wrong. I fire clients like that. Get out of here. I don't want to know you. I don't want to see you. Get off my client list because these are your taxes. I need you to be aware of what's going on here. So I sit down with my clients and we do this. We pull out last year's tax return, literally pull it out. We literally look at what was your total income, taxable income last year, what was your total tax, what's it going to be different? And I'm telling you, in 3 minutes and talking to a client, I can tell, well, I think your tax is going to be up 30 grand. What? How'd you know that? Pretty simple. I'm looking at your financials and the net is 100,000 more than last year. You're going to pay another 30 grand in taxes. What I'm trying to really point through is get to the tax strategy. Get to the tax strategy. And most people, the tax strategy is what? Pay what I can before year end, get assets bought before year end that I need, right? And that's usually the rule of thumb. Makes sense, right? But potentially the tax deductions are worth more next year. So do you want to do that? Because if your income's lower this year, right? Maybe your tax is a lot less. Maybe you're looking at financials and you're like, well, my income last year compared to this year, I'm down 100 grand. Well, then you don't want to go prepay a bunch of stuff per se. So for cash basis taxpayers, the IRS allows per law, not aggressive, it's the law. You can prepay up to 12 months of expenses as long as you've used up those expenses within the 12-month period. So you can prepay. Could I prepay 12 months of rent? Technically, yes. Would you want to do that? Maybe. I don't know. Probably not. Depends. But get to the strategy. How do you get to the strategy? How do you get to the strategy? Doing what you're doing right now. So I want to thank you for tuning in. I appreciate you guys being here. It was a free seminar. It was definitely more entertaining than probably any other seminar I've delivered. But I was having fun, and guess what? I'm tired. It's dark outside. I don't have anybody that I'm actually looking at and talking to. Amanda, if you'll come on in. But I want to make sure you know I've got 4 seminars coming up.
Wanted to remind you to let it sit for about 30 seconds after you're done.
Okay, but you're going to get me on camera here in a second.
Yeah.
Remember. So got the federal business update, federal individual update. It's available for CPE. Check that out. The ERT seminar, going to blow your socks. Look at all this stuff that I help you figure out what that is. As always, thank you to my YouTube subscribers for all the support. Again, if you've made it to here, come on. If you're not a subscriber, let's go. I got a 1/10 of a penny for you to be here for 2 hours plus. Thank you for that, non-subscriber. But I would love for you to be a subscriber. Why? I don't make any more money, but I love to see the numbers go up because it tells me that I'm doing a good job. So I'd love for you to be a part of this community. Turn on your notifications. We got a lot more videos that are going to be coming out. And I will end it with this. Okay. I want you to go to my website. I want you to check out my seminars. I'd love it if you'd sign up for one. If you don't, no worries. Check out all my free videos. And then let's go ahead and take it off of the, I guess we just stop sharing the screen. Is that all we do?
Mm-hmm.
All right.
All right. So
Then when I want to end it,
no.
I'm just going to say goodbye to everybody.
Okay.
Yeah. All right. I just wanted to get to here. I guess I'm on full screen now to say thank you. I appreciate you. I love you. Thank you for being all the way to here. Hopefully you're doing well. Tell the kids I said hi. Tell the significant other I said hi. Tell your business owners, the fellow ones said hi. Tell people to tune in. All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right. You all have a great one. All right.